Thank all of you for being here. My name is John Jacobson, Vice President, Senior Trust Officer at Security National Bank. I want to tell you what a gem, a diamond in the rough you guys have with having Skip Kenyon here in your community as the Head of Trust and Senior Trust Officer here. And my appreciation to Kim and Hannah also for all they've done to prepare for this great event. You know, they always say a prophet's not without honor except in his own hometown. Skip Kenyon, ladies and gentlemen, is the president, the elected president of the Iowa State Bar Association. It is really the highest honor that can be bestowed upon an attorney in Iowa because he is elected by his peers, all of the other thousands of attorneys in the state of Iowa, to represent them and be the tip of the spear in leadership for improving the legal profession and the wheels of justice to grind exceedingly fine and exceedingly well and fairly in our great state of Iowa. Skip is very accomplished, and specifically, he's one of those great rarities. He is an attorney that knows trust, estate, and probate law. It's a very specific area of the law that not a lot of people have mastered, but it's a very important area of the law because it involves all of the intergenerational transfer of wealth that's going on today. A very important part of that is the ability, whether it's ag land or maintaining your investments in stocks, bonds, cash, whatever, to be able to invest that prudently without taking great risks, but with excellent returns. And my colleague here, Mr. Damian Howard, who is our Chief Investment Officer and Vice President at Security National Bank, has one of the best records, I think, in the region of being able to prudently manage portfolios for trust and other fiduciary beneficiaries with outstanding performance returns while maintaining very low and acceptable risks. It's a skill that is not in superabundance out there, but it's the skill that Damian and his crew have. And he's prepared a magnificent presentation for the 24 plus of us here this evening in talking about where we are in the United States economy today and where we're heading, both in terms of the markets, the gross domestic product, inflation, and a whole variety of other issues. So please join me in welcoming my good friend and colleague, Mr. Damian Howard.
Thanks. I have the stuff on the slides, but you also have them in front of you, and I don't know if I want to make you guys turn around, so I'm going to just go back up here, and you guys can just check when you need to on the slide. I guess you can stay here. You know, first off, you know, at the trust department, turn around, or just move with it. In our trust department, we're rather unique. We'll hold farmland, we'll hold all kinds of other properties and stuff, but traditionally trust have, you know, stocks and bonds and things like that, investment. But we're open to own farmland, investments in private companies and everything else. A good quarter of our assets are non-publicly traded assets. So we're open to a wide variety of assets, and unlike some other trust companies, we don't shy away from maintaining the family farm for generations or a private business. Sometimes we have some private businesses and trusts that we maintain for a couple of generations and stuff. Security National Bank, we're a family-owned bank in Omaha, owned by the Landon family, a modest-sized bank. We're only in Omaha on the banking side. We do have a trust office in Des Moines, so only trust only. So we're a little bit bigger, and our trust department's bigger in assets than the bank. You know, the lawyers, since we're all lawyers around here, we have a disclosure statement that basically says that I'm going to be wrong sometime, but I don't know which part of this presentation is going to be wrong. So, again, we're happy to partner with Iowa State Savings Bank. My background a little bit. I grew up in southern Indiana, in small town southern Indiana. Went to Wabash College and then Indiana University for my MBA. I've had a variety of jobs in banking and investments for over 25 years. I've been Security National. A little over 2 years before that, I was at Woodman Insurance Company, the big tower in Omaha. I ran there, about $1 billion stock portfolio. So this here is kind of a busy chart, but it shows all the economic expansion since 1960 on until we get into a recession. You know, for instance, this blue chart was, you know, the expansion, the big blue line, the expansion that started in June of 1960 and went all the way to about 40 quarters, so 10 years, and then from start to beginning, the economy grew about 155%. The average expansion after you go to a recession lasts about 28 months, about 7 years, 28 quarters, about 7 years, and the economy grows about 20% from start to finish. Our expansion that we've had, which has gone a very long time, which is this red line here, we're about 36 quarters. So a very long, about 9 years of expansion. The problem is we haven't gone very far. It's like going from Omaha to Chicago, but only traveling 35 miles an hour. We've gone a very long time, but we've only gone about 12%. The economy's only from start to finish, we've only grown 12%, and that's just too slow. And that's kind of why everybody feels like, you know, this is not a very good, healthy economy because we've gone so slow. One of the upsides to growing slow is there's not a lot of excesses. Remember our previous boom, we had a big excesses in housing and stuff, and that caused the Fed to get overexcited and raise rates and put us into a recession. And before that, it was commercial properties or the internet bubble. We had bubbles. There's no bubbles out there. Oil was a little bit expensive at $100 a barrel, but that's self-corrected. So we don't have a lot of bubbles out there. So that means we can still go a long time. Even though the recovery is pretty long and the tooth pretty old, we haven't gone very far, so we can still go a lot further. And this red dot here is where we'd be at the end of the year, even if we hit everybody's forecast. We'd only maybe be up to 14%. So we've got, you know, at this pace to get to 20%, we got another 4 or 5 years. So we can still go a pretty long time. One of the things we're watching, this is wage growth. This is basically the average pay increase that everybody in the economy gets. You know, for a very long time after we got out of the recession, the average worker was only getting about a 2% pay increase. And so it's kind of tough to get ahead when you're only making 2% year after year, and inflation sometimes is running 2%. But recently, we're seeing this uptick. Because we're getting very close to full employment, wages are starting to rise. There's worker shortages in Iowa and Nebraska, especially with very low unemployment. We're having some worker shortages, and also at the lower end. So what we're watching this is wage growth. If it gets up to about 3.5%, then we can start seeing some push up in inflation. But you know, it's still going to take 2 or 3 years of 3% wage growth in order for inflation to be a worry. So we're still a long ways off where we have to worry about a recession or so. And why is that important? We'll get to that later. You know, one thing that is happening is inflation's picked up. The latest numbers of inflation is about 2.7% year over year inflation. A lot of that has to do with oil. Last year at this time, oil was about $35 a barrel. It shot up to about 55, now it's down about $50 an barrel. So we're seeing the effects of that right now. As we get through summer, end of summer, that'll start anniversarying and some of inflation will come down. So we're seeing a pickup in inflation. We don't think that's going to last. It's going to come down into the 2%. But 2% still is significantly better or higher than what we were doing in the early, 3 or 4 years ago, where inflation was almost zero. So we have 2% inflation, 2% growth. This is what we publish quarterly and stuff. It's kind of our, we call it a recession dashboard. It's just a quick overview of things that we need to see. If we think there's a recession, it's going to give us a heads up, some of these going. Now, everything that we see here, employment indicators, credit metrics, spreads and stuff, they're all in a growing category. And they're getting better. These are what these arrows are in. Is it better this month than it was last month? So the economy right now is actually better now. We're in better shape now than we were last year and the year before. So we're actually got to have some momentum in the economy. If you look at corporate earnings, they had been flat for 3 years in a row. And the stock market's kind of flat. We had some bump up. But starting in September, these signs started showing up better and better. So overall, we're having the economy's pretty good, but it's not great. We've got 2% growth. So this is what our forecast is for the economy. We think the economy will grow about 2% this year. It grew about 2% last year. So we don't see it growing very much faster. We don't see it growing 3%. Some of that has to do with, we're running out of workers. The number of people working have probably only grown now less than 1% last couple of years. Last year, the beginning of last year, was growing about 1.5%. We were adding 1.5% more jobs every year. Now we're running out of workers. Baby boomers are retiring. So the number of workers are only going up about 1%, maybe even less than 1% year over year, the number of jobs created. Some of it we're running out of workers, and some of it, mainly we're running out of workers. And then efficiency is not that great. Prices, we think the Fed has a 2% goal of pricing, and we're there. So the Fed's met its goals. We think the Fed's going to raise rates another couple times this year. So interest rates will go up about 0.5% between now and year end, and another about 1% next year. So a slow rise in inflation of interest rates for the next couple of years. Not fast, not a huge jump up, but a slow rising interest rate environment. Treasuries and stuff. And we are likely, without a major blow up in the Middle East or something, to have seen the lowest rates of the next generation. So lowest mortgage rates. If you got your mortgage a year and a half ago, that's probably going to be, you want to keep that for the next 20 years. It's unlikely to ever go back that far. There's a stock market in it. We view the stock market as slightly overvalued. Kind of like everybody else, and the market is trading about an 18 times forward earnings that we're going to earn the next 12 months. Historically, the market trades about 16 and a half. That's the average. We really like it when it's down to 14. That's a raging buy when the market's at a 14. At 18, it's overvalued. At 20, it's really overvalued, and then you have to get out. But as you can see, in the early 1990s and 2000, when we had the dot-com boom, it can go from overvalued to really overvalued to really, really overvalued. So it doesn't mean that it's going to go down because we're overvalued. It just means that returns going forward, the next couple of years, are probably going to be lower. The adage is the stock market, and it's true, from the last 130 years, the stock market has given you a 9% total return. However, we don't think that's possible or likely for the next 10 years, at least. We think about a 6% return, 6 to 7% return in the stock market is what to plan on. Last year we did better. The market was up 13%. We were up in the 18%. But when we do our planning, we tell our customers, if it's better, we'll take it. But if you want to do planning and how much return, plan on about a 6% stock market return and maybe about a 3 to 4% on bonds on fixed income. So this is a busy chart, but there's a question. Okay, we think interest rates are going to rise. a lot of times when interest rates rise, the stock market falls. If you go back in history and look, you know, as long as the 10-year Treasury, which is now 2.4%, 2.5%, as long as it stays under 5%, we're pretty good. Because historically, you know, a rise until it gets over 5%, it doesn't harm the economy. Whether that holds true going forward or not, it's yet to be seen. But history tells us, you know, since I've been alive, that, you know, as long as the Treasury's under 5%, it probably won't hurt the stock market. So interest rates look good. Here's kind of my favorite slide, and I stole this from J.P. Morgan. And it's a busy slide. The gray bars show what the price return of the stock market, the S&P 500, is every year. For instance, last year at 15, prices were up 10%. This excludes dividends. Prices were up 10%. The red dots are inter-year declines. So last year we had 11% inter-year declines. January and February were pretty bad in the stock market. You know, January was the worst January in the history of the world for the stock market. So this shows you, kind of tells me that expect a 10% decline every year. Build your portfolios to withstand a 10 to 15% decline, and don't get too upset if the stock, you know, we can have a market correction next week. You know, there's no real rhyme or reason why they come. Afterwards, you can come up with an excuse, but one happens pretty well every year. And the other thing to point out that 75% of the time, 28 out of 35, which is 75%, the stock market has a positive return. So those are really good odds that the stock market has a positive return. And plus, since we're almost at a record, an all-time high, every market decline that we've ever had, we've corrected from. So stay in the market, stay invested. We can reduce risk within the market by changing your portfolio, but don't panic when we have a decline. We're going to have a 10% decline sometime this year. The chances are that we will. You know, we haven't had one yet. We haven't had one for over 13 months. But chances are we will have a 10% decline this year. And, you know, so if you know you're going to have a 10% decline, why not sell out? This tells us why. Okay, in slightly different period from beginning of 97 to the end of last year, the stock market, when you're fully invested, you had a 7.7% return. If you missed the 10 best days over this long period of time, your return was cut in half. So being out less than 1% of the time, if you happen to just get the 10 worst days, your returns are gone. If you miss 60 days out of this time period, which is, I believe, 16 years, your returns, you're negative. So this is why why market timing doesn't work. And the fact is also, 6 of the 10 best days are within 2 weeks of the 10 worst days. So not many people, including me, if I'm scared out of the market and the market's dropped 5% in one day, am I willing to step back in the market and get in? You know, this human psychology isn't that tough to go in. Most people aren't. That, you know, most people say, okay, I'm going to wait till it recovers a little bit, maybe 10%, then come back in. You do that, you miss most of your return. So the key is to stay invested, build a portfolio that can withstand and live through these 10% declines. So that's, you know, our goal. Here, you know, our investment, what we think the investment is going to be. You know, we have earnings about 128 for the S&P 500, a little bit less than the market. For the last couple of years, we've been not as aggressive as earnings prognosis and stuff, and we've come in pretty well accurate. Most of the street and everybody else is usually a lot more optimistic than we are. We have the S&P 500 ending the year at 2,312. That's a little bit below what the market's trading now. So our best guess is going to be we're going to have a decline sometime this year, and we're going to have a recovery, come back to where we are now. Now, most likely I'm wrong on that, and the risk of it's probably on the upside, because in my projections here, I don't have anything coming out of Washington positive. So this is kind of the steady state. We don't get tax reform. We don't get regulatory relief. We don't get health care reform. We don't get personal tax reform. This is kind of the same steady state in Washington. If we do get that, I'll probably have to raise my expectations a little bit, but most of it will come into 18. And also, if we get it, the market's probably going to anticipate more. So, our base case right now is we don't get any of this stuff done in Washington within the next year and a half. So how do we manage our portfolios with that in mind? We take a balanced approach. You come into us, we'll talk to you. You come into Skip and he'll talk to you. What's your risk preference on? We'll build a portfolio for your risk preference and also how you need to pull out money. If you don't need the money for 10 years, 20 years, you can afford to take more risk and also hopefully get better returns. If you need the money this week or if the market goes down 5% and you call me up and I can't take it anymore, I'm down 5%, then we're going to put you in less in stocks, more in bonds. So our typical portfolio for the vast majority of our clients is that middle one, what we call balanced or growth. 30% of it we'll put into high-grade corporate bonds, some treasuries, but very solid investment bonds. So when the market goes down, these hold their value or go up. It's a perfect hedge, or it's a very good hedge against stock market decline. Unfortunately, we're only getting about 2.5%, 3% interest rates right now. In a year or two, we might get 5-6% interest rates, we hope. But right now, you can't get a lot of money out of there. We have some high yield in there, which is providing about 5% interest rates, but they're a lot riskier than other investments. And then we've added some inflation protection because we think the risk right now on inflation is to the upside. If I'm wrong on my inflation, I'm probably wrong of inflation being higher because wage growth starts picking up a little bit faster than I think. So we added a little bit of hedging inflation protection bond. Inflation protection bonds are securities issued by the Treasury, and they add to your principal. For instance, if you buy a $1,000 bond and inflation, it happens to be 2%, they'll add $20 to your principal when it matures. So it goes up, the money you get back goes up as inflation goes up. So we've added that in there. That's kind of new for us because we think the risk on inflation is to the upside. Then about 43% is large corporate stocks. That's the stock portfolio that I manage, individual stocks. We have two portfolios. One's a little bit growthier than the others, but they have a lot of common stocks, and we can go over that a little bit later. Then we'll add mid-cap, small-cap stocks, and that we do through mutual funds because it's kind of hard to build a big enough portfolio for most people. Then we have a little bit of international stocks. We're not very high on international markets, and that's helped us. So the last couple of years helped us outperform because international stocks have underperformed. Year to date, they're a little bit better, but we think the United States is still at our 2% slow growth is still the better economy to invest in versus Europe. We might add a little bit of Asian exposure in the coming months. We're still reviewing that. And then we have a little bit of real estate. Again, so we have two portfolios, a core growth and a core value portfolio. And it's a stock portfolio that we run inside. We think that we're stock pickers, and we think that instead of mutual funds, where possible, we'll use individual stocks and individual bonds. That way we're not paying for management twice. You're not paying Iowa State, and you're not paying another manager to manage them. and we've been pretty good on it, on our portfolios. Our value portfolio, we've got a 2.2% dividend yield. It is growing faster than the market. So we still like growth, but it should grow faster than the market, should do a little bit better than the market, and it has a nice dividend yield. We like utilities, we like staples, we're overweight staples, and staples are like Clorox, Kroger, things that you buy all the time that aren't going to go down, and when the market goes down, they're going to hold up a little bit better. This is a conservative portfolio, and it really does outperform when the market goes down 5-10%. We usually only go down about 7 to 3%. So we make a lot of it up when the market does go down. And then our growth portfolio is those people who have a longer time horizon are able to take more risk. That's usually what our doctors go into, because doctors take a lot of risk in their investment portfolios. And then here's the point I want to make to everybody. It's the last slide. So if you're 65 today, people think, okay, I'm 65, I'm retiring, I want out of the stock market. This point to say that you've got to invest. You got this money that you have at 65 that you're retiring has to last a lot longer than you think. You know, and if you want to leave money to your kids and stuff, that money, that lifetime of that portfolio could be 50, 60 years. Even if it's to cover yourself and you go, I want to leave my kids $1. No, you've got a pretty good chance for a couple, about a 40% chance of one of you living into your 90s, well into your 90s. So 30 years. This is a 30-year portfolio when you're 65. And over 30 years, if you just had bonds alone, inflation over 30 years is going to halve the value of the money. Just think of how much a dollar would buy 30 years ago, and think of that going forward. So if you had a $1 million portfolio in 30 years, that's only going to be worth $500,000 in purchasing power. So, which means in order to even beat the low inflation that we have here, you have to have more equities in your portfolio than you really think. So, one thing, I've got there, we send out a kind of a newsletter, email it out every quarter. One will come out probably next week, late next week. I'm finishing writing it, and we send it out and I have business cards up there. You can email me saying put me on your distribution list, or you can follow me on LinkedIn if any of you guys are on LinkedIn. I'm on LinkedIn, and that's established on LinkedIn. And every once in a while, we'll put out pieces. If something major happens in the market, we'll put out a little blurb, and it goes out on an email list. So that's kind of all I have. If there's any questions, I'd be happy to answer. And here's my contact number. Again, it's on the sheets there if you want. You can send me an email, give me a call if you have any questions.